and welcome to our 2023 investor presentation. For those of you that don't know me, I'm Paul Bendall, CEO of the management company of First Mortgage Trust. And it's great to see so many of you here today, and as Michael's alluded to, we've had record turnouts in all of the events that we've run so far. And so not only would I like to thank you for your attendance today, but also your trust and continued support in First Mortgage Trust. I'd also like to extend a warm welcome to some of the prospective investors that we have here today, and I know there's quite a few of you out there, so welcome. It's great to have you here. These meetings are an important opportunity for us to not only update you on what's happening with the business, but also an opportunity to talk face to face. And we know that it's something that's really important to you, and we also know that it's something that differentiates us from other investment options out there. And as we get bigger, it's something that we really want to ensure that we keep is that personal touch. And we're really working on how we can actually enhance that and bring more of it, and certainly as a company continues to get bigger. So today I'm going to cover how our loan book has performed over the last year or so, especially in light of the tough economic environment that we've encountered. I'm going to provide an overview of FMT, where we've come from and what has changed for the manager in the last 12 months, and then also have a quick look at what the next 12 months and beyond looks like for us at FMT. And at the end of my presentation, we'll allow time for questions. And if you don't want to ask a question publicly or we run out of time, please feel free to come up to myself or one of the team afterwards, and we'll be happy to answer any questions that you've got. And please note today that my presentation, I'm not providing financial advice. My presentation will provide factual information only. So I've kept the lawyers happy, so that's good. But my main goal today is to convey a picture of a company that knows what its core business and values are, has continued to thrive despite a pretty difficult operating environment, and is well placed to execute on the opportunities that will present themselves in the future. So looking firstly at where the fund sits today and how we've performed over the last 12 months, the fund size now stands at over $1.65 billion, having grown by well over $80 million in the last 12 months. Our loan book is $1.45 billion, and I'll talk about that in a bit more detail in a moment, because that's largely where we generate your investment return from. We now have over 60 people located in offices in Tauranga, Auckland, Wellington and Christchurch. So when other companies in New Zealand have shrunk, we've actually continued to grow. We now have over 6,400 investors, meaning that we've added over 400 investors in the last 12 months, which shows the support and confidence that our investors have in us. And as Michael has alluded to, today our loan book is secured by over 1,300 first mortgages located in the key New Zealand markets of Auckland, Waikato, Bay of Plenty and Christchurch. We've also hit a significant milestone in the last 12 months, having distributed over $100 million to our investors. And this really highlights the stability of our performance in a pretty tough economic environment. The headline numbers are impressive, but it's the numbers that sit behind this that really bring the quality of our performance to life. So our average loan-to-value ratio is 47% on what are generally pretty recent valuations. Now, a year ago when I spoke to this group, it was around 50%, and this highlights the conservative stance that we've taken, noting the market conditions that we've encountered. And for note, our 5-year average is around about 50%, and so we've been tracking below that, which is quite impressive when you think that property values have fallen about 15 to 20% over the last year. At these levels, our lending ratios are significantly lower than those permitted under our governing documents. We have over 650 loans with an average loan size of just over $2 million. The average loan size has increased slightly, and which reflects where we've seen the best lending opportunities. However, it's important to note that whilst the average loan size has increased slightly, the number of first mortgages that we hold has increased by 20%. So for our 650 loans that we have, approximately 1,300 first mortgages registered, so meaning that on average, every loan that we do is secured by at least 2 properties. And this contributes to our low loan-to-value ratio and helps spread our risk even further. Our average loan term is 16 months, and this has remained stable over the last year. The loan portfolio is well diversified by both asset type and geography. So the slide on the screen at the moment shows that by geography, our loan portfolio is 63% in Auckland, 5% in Waikato, 6% Bay of Plenty, 13% Wellington, and 9% in Canterbury. So that means that over 96% of our loan portfolio is located in New Zealand's 5 main centres. And this is very deliberate, as historically these markets have performed the best and been the most reliable due to their population growth and employment opportunities. By asset type, as shown on the slide, our loan portfolio is 59% residential, 33% commercial and 8% rural. We also monitor the portfolio by how much development lending that we fund. So on a drawn debt basis, this currently sits at about 17%, which is lower than our average over the last 3 years, and again highlights us managing to the market conditions. One stat that we're very proud of are our 90-day plus loan arrears, and they sit at 0.7%. Now, to put this in context, this puts us in line with New Zealand's major banks, which are generally between 0.4% and 0.8%. And then if you consider us alongside New Zealand's smaller and regional banks, they're as high as 2.8%. So this is an impressive result and really testament to the quality of the lending that we're doing. And on a final note, the quality of our loan book is aided by the fact that we don't lend to first home buyers. We're incredibly proud of these results, which are driven by three key factors, being our dedicated and highly skilled team located around New Zealand. I'm incredibly proud of what our team has and continues to achieve. Secondly, our goal to optimise investor return rather than maximise it. So that means we take the time to find the right balance between risk and return. And thirdly, our unwavering focus on our decision-making framework, which is our investor-first mentality. You would have heard me say this last year, is when making a decision, we always ask ourselves, is this in the best interest of the investors? And if the answer isn't an emphatic yes, we move on. And this is evidenced by our loan book growth, which has been reasonably flat over the last 12 months. We anticipated that property values were likely to fall. They were simply too high and a correction was necessary. So we started preparing for this for over 2 years ago. Rather than chase growth to maximise return, we've been very selective, noting the economic environment and ensuring that we balance risk and return. We have held higher levels of cash than normal, managing to the market and ensuring that we're in a strong position to take advantage of the changes in the market when they present themselves. These are the key ingredients to our success, and in 27 years, we can proudly say that we've never lost a cent of investor capital. One of the questions we get asked is, do you lend to the people that the banks won't lend to? And in part, the answer is yes, but the banks should be lending to these people. Many are successful business owners who want to invest into their businesses, and many are highly experienced and successful property investors. The banks have lost the personal touch, and it feels like if the computer says no, they aren't interested anymore. We, on the other hand, take time to understand the people and what they're trying to achieve. We consider both their ability to service and repay the loan, but also we take the time to understand the underlying security that sits behind the loan. We're very selective in who we lend to. On average, we only write 1 in 10 loans which come across our lenders' desks. So put another way, we say no 90% of the time. As I've said, our aim is to optimise investor return by balancing the risk and return. Where we position ourselves in the market as being slightly more expensive than the banks, but easier to deal with, and then cheaper than other lenders in the market. This enables us to cherry pick the very best deals, and as I've mentioned, we say no 9 out of 10 times. And because there's a saying that lending money is the easy bit, it's getting it back that takes a skill, and that's what we focus on. So that's a quick overview of how the loan book is performing. I'll now provide a quick overview of First Mortgage Trust, particularly for those that don't know much about us. So First Mortgage Trust is managed by First Mortgage Managers Limited, which is a licensed manager under the Financial Markets Conduct Act. We are regulated by the Financial Markets Authority, or FMA as it's commonly known. And due to our size, we now also report to the Reserve Bank of New Zealand on a quarterly basis. In addition to this, a key feature of our structure are our supervisors, trustees, executives for the Group Investment Fund, and they're represented here today, so welcome to trustees team, and Public Trust for the PI Fund. They play an integral role in the governance of First Mortgage Trust and have the right of veto on all of our lending decisions. And this is an important point. Most organisations that lend to the property sector are companies, not trusts. They don't have the structure and regulatory oversight that First Mortgage Trust has. Our structure sets us apart in the market and provides another layer of comfort for our investors. As I've mentioned, we're a heavily regulated entity, unlike some other investment options out in the market, and as best as we know, no other property lender, aside from the banks, have the same level of regulatory oversight as we do. And we embrace this and work very closely with our regulators. Our board also plays a very active role in the governance of First Mortgage Trust. We have a number of board subcommittees, and a key subcommittee is our Assets and Liabilities Committee, which meets monthly to review the performance of the loan book and provide guidance on the future direction. And at a management level, we have a highly experienced team in all of our core functions, including credit risk, operational risk, finance, lending, people, and marketing. We are 100% New Zealand owned. We are the classic New Zealand Inc. story of New Zealanders helping New Zealanders. As I mentioned earlier, we now have over $1.65 billion in funds under management with over 6,400 investors. And while our roots are firmly planted in the Bay of Plenty, where we started 27 years ago, today we stand as a nationwide fund manager with expertise in investments and property finance. We enjoy an extremely loyal client base and try to focus on the personal touch. And from our most recent investor survey, we scored a Net Promoter Score of 69. Now, to give that some context, anything above 30 is considered to be good, and the banks struggle to get anywhere close to 30. 80% of our investors come through word of mouth, and once someone invests with us, 80% of them will invest further money. We're very proud of that, but we don't take that for granted, and so we'd like to thank our investors for their continued support and trust in us. The manager of First Mortgage Trust essentially meets all of the running costs of the trust. This includes all staff, premises, technology, cyber security, and other operational costs. In addition to these costs, the manager, at its own expense, also makes a number of sponsorships and donations on your behalf. We are a major sponsor of the Save the Kiwi Foundation, along with numerous other organisations, charities, and community groups. And the Save the Kiwi team have actually asked us if people can go on and vote for the Bird of the Century. I don't know if you've seen that, but they want the Kiwi to be the Bird of the Century, and we think there's no more worthy recipient than our national bird. We also have a FMT Annual Youth Sponsorship Grant, where we provide a grant to a young person aged between 16 to 25 who is excelling in their chosen field at a national and or international level in sport, music, or the arts. We're also very mindful of our obligations as a good corporate citizen, and we continue to develop our environmental, social, and governance framework, or ESG as it's commonly known. We are a very active manager, and we continue to invest very heavily into the management of First Mortgage Trust. In the last 12 months, we've added several new roles, including further resourcing into our credit, finance, and data and analytics capability. We are also investing into replacing our core technology systems. We have recently undergone a platform transition for the lending side of the business, and we have now started to focus on the investor side of the business. As part of this project, we'll be developing an investor portal to provide you with more visibility to your investment, as well as enhancing communication and streamlining processes to improve your client experience. Our core chosen platform is Salesforce, which is considered to be a premium product and used by financial institutions globally. We also invest very heavily into cybersecurity, and our systems are monitored 24/7 by both state-of-the-art technology, which includes AI, along with a dedicated cybersecurity team. In addition to this, Salesforce has a robust cybersecurity framework, and we also use the Salesforce Shield product, which provides an even higher level of data encryption again. Now, to make sure that we haven't missed anything, we've actually recently had our cybersecurity framework independently audited by a specialist cybersecurity company. We're pleased to say that we scored very favourably on a New Zealand basis. However, we will continue to enhance our overall cybersecurity framework. So as you can see, we take the protection of your data very seriously. Despite this investment into technology, though, we won't be moving away from the personal approach. We see technology as an extra service that we can provide as opposed to something that's going to define us as a company. A key reason for our success are our people, and we have a robust employee value proposition, which includes benefits such as health insurance, flexible working, training, and career development and progression. So what does the next 12 months and beyond look like for us? We look ahead with confidence. We've performed well, we've made good decisions, and we're in a strong position to take advantage of the opportunities that are going to present themselves. Lending opportunities in New Zealand continue to grow. We estimate that the market we operate in makes up about 7% of the overall lending market, and this has grown by about 2% in the last year. In Australia, it's now 27%, and globally now makes up close to half of the global financial system. New Zealand is undergoing a structural shift away from bank dominance and lending, which is in line with the international trends and evidenced by New Zealand having experienced 300% growth in this sector over the last 3 years. And I was reading an article over the weekend which suggests now that in the US, traditional banking only accounts for 30% of all lending. In terms of the economy, we still, and I'll leave that to Tony to talk about it in a bit more detail, but we still see some challenges ahead with inflation staying higher for longer and the global geopolitical situation creating continued volatility. This is likely to see continued investor focus on lower risk, stable investments that generate a consistent return. Despite the macro environment, we're seeing the signs that the property market has reached the bottom of the cycle and is in fact showing signs of growth. Our size means we have access to the very best lending opportunities in the market that we choose to operate in. We have managed our liquidity levels carefully, and as I've mentioned before, we've performed strongly in a pretty difficult market, and it leaves us very well placed. We're about to launch a wholesale fund which will provide access to a wider investment pool. This will invest solely into our group investment fund, so we won't be moving away from our core business. And for our retail investors, it will mean we can potentially access different lending markets, and it means that we'll be able to hold lower levels of liquidity, which in turn will enhance return for all investors. As you can see on the graph, we have a demonstrated track record of generating stable returns. In the last 6 quarters, our return has steadily increased at a time when other assets have experienced volatility. From an investor perspective, we anticipate that our quarterly return will continue to increase over the coming months on the basis that there's not a material change to our current position. And this has been driven by the repayment of older loans at lower interest rates being replaced by new loans and priced at the current environment. As I mentioned earlier, in the last 12 months, we have distributed over $100 million to our investors. We have over 27 years of success behind us, and no investor has ever lost capital with us. Our results are achieved by a highly skilled and experienced team, underpinned by our values, which are teamwork, integrity, and achievement. And finally, our commitment to you. We strive to provide the best customer service. We will always fully comply with all legislation. We will always act in our investors' best interests. We have a relatively conservative operational policy, and we've maintained our commitment to steady, careful, and well-managed growth. So once again, I'd like to thank you for your attendance today and your ongoing support and trust in First Mortgage Trust. And I'm happy to answer any questions that you might have.
Just short, I hope. How does the wholesale fund work?
Yep, so the question there is how does the wholesale fund work? So it's for people that are eligible investors under the legislation for wholesale investors. And what we're looking for there is it's a fixed term investment, so a 2-year commitment. So you have to be qualified as a wholesale investor under the relevant legislation. So the question there was, how do we see digital currency affecting us? We think it's too early to tell. I think that's in its infancy, and it's something that is not on the horizon for us at the moment. Yep, so the question is how our development loan book is performing. It's performing really well. In fact, we don't, of our non-performing loans, which are very small, we don't have any development loans that are currently non-performing. So we have a pretty robust management of the development loans, so they're monitored on a monthly basis by an independent quantity surveyor. So we have really good visibility into how that loan book is performed. So the question is, why don't we lend to first home buyers? And that answer is reasonably simple. I'll kind of give an example of a first home buyer. The banks will lend to 80-90% to a first home buyer, and if that person loses their job and the property market falls 10 to 15, 20% as it's done in the last year, then that loan is potentially underwater. We, on the other hand, are going to lend to experienced people and at much lower LVRs that have got strong equity positions. And an example of that is someone that wanting to borrow $1 million against an $8 million property to invest into a business. You take a highly leveraged first home buyer versus an experienced person. I know which risk I'd rather take. Well, if there's no other questions, as I said, the team are all here afterwards, so please feel free to come up to us and ask any questions that you might have.